everyone, and welcome back to week 2 of International Financial Management. Today, we are going to explore a topic that is absolutely fundamental to how the global economy functions, and this is exchange rate regimes. Now, you might wonder, why does it matter whether a country fixes its exchange rate or lets it float freely? Well, the answer is that the choice of exchange rate regime has profound implications for a country's monetary policy, inflation control, trade competitiveness, and overall economic stability. It is one of the most important policy decisions of the government and central bank that they can make. In this lecture, we will start with some historical context, the collapse of Bretton Woods and the evolution towards modern exchange rate system. Then we will systematically go through major types of exchange rate regimes that countries use today, from the most rigid to the most flexible. Finally, we will discuss the fundamental trade-offs involved. By the end of this lecture, you will understand not just what different exchange rate regimes are, but why different countries make different choices based on the economic circumstances. Let's get started. In 1971, President Nixon announced that the US would no longer convert dollars to gold. Bretton Woods collapsed. After Bretton Woods collapsed, the world faced chaos. Exchange rates were fluctuating widely. International trade became unpredictable. Business couldn't plan ahead because they didn't know what exchange rate would be tomorrow. The immediate response, particularly in Europe, to create a mini stability zone. In 1971, shortly after the Nixon shock, what came to be called the snake in the tunnel was introduced. We have discussed it in the previous lecture. Let us recall it once more. The idea was this: when the dollar fell from Bretton Woods, European currencies began to fluctuate against each other. The snake in the tunnel was an attempt to limit this fluctuation, and it was very necessary because there was a lot of trade between the European countries. So, hence the member countries agreed to keep their currencies within a narrow band. Hence, we see the snake within the tunnel. They were trying to build a common market, but if their currencies kept fluctuating against each other, trade became impossible to predict. A French exporter selling to Germany couldn't know what price he'd actually receive after 3 months. The snake proved to be useful but a temporary solution. It then led to the conceptualization and development of the European monetary system and Eurozone. It evolved into something more formal and ambitious, the European Monetary System, or EMS, which was established in 1979. The EMS was much more structured arrangement. It had clear rules, mechanisms for interventions, and a common unit of account. It was designed not just to stabilize exchange rates, but to lay the groundwork for deeper economic and monetary integration in Europe. It was in many ways the predecessor to the European Union and the Eurozone as we know it today. Why is it relevant to us? Because the European experience shows how countries can choose to fix exchange rate with each other for political and economic reasons, even when global markets are pushing towards floating rates. Within the European monetary system, something interesting happened. European countries created a new currency that didn't belong to any single nation, the European Currency Unit, or ECU. Think of the ECU as a precursor to Euro. What was the ECU? It was a basket currency, a weighted average of the currencies of European Community member states. Each country's currency had a weight in the ECU based on its economic size and the share of intra-community trade. So the ECU wasn't German mark or French francs, it was blend of all of them. Why did they create it? Several reasons. First, it provided a neutral unit of account for European transactions and accounts. No single country dominated. Second, it helped to reduce exchange rate variability among European currencies by giving them a common reference point. Third, it was a test run, a way to see if countries could successfully coordinate their monetary policies. ECU was the weighted average of a basket of EC members states currencies periodically adjusted based on economic size and intra-community trade. The ECU proved successful. It reduced exchange rate volatility and helped achieve monetary stability across Europe. But Europe wanted to go further. They wanted true monetary integration. In 1991, Maastricht Treaty was signed. This was a historic decision. The European committed to introduce a single European currency, what would become the euro by 1999. The Maastricht Treaty set out the framework. There would be 4 stages leading to the euro. Each stage had specific requirement and milestone. Let's understand each stage in detail. The first stage was all about getting the foundations in place. Remember, when the EMS was created, many European countries still had capital controls. This meant you couldn't freely move money in and out of the country. For a monetary union to work, you need free movement of capital. So, stage 1 focused on regulating these financial controls. Countries gradually opened up their capital accounts, allowing money to flow freely. At the same time, the role of the ECU expanded. The ECU evolved from just a unit of account into something more like a quasi currency. It was used for more and more transactions. And here's something important. Member countries were asked to contribute 10% of their foreign exchange reserves, their actual gold and hard currency reserves, to establish a European Reserve Fund. This was a significant pooling of resources. Stage 2 moved to the institutional level. Remember, for a monetary union to work, you can't have each country's central bank do its own thing. You need unified policy making. So, the European system of central banks was created. This was the institutional infrastructure that would eventually become the European Central Bank. Countries also began moving towards unified monetary policy across member states. Central banks started coordinating more closely. Interest rates began to converge. Before a country could join the euro, it had to meet specific economic criteria. These were the Maastricht criteria, named after the treaty. The criteria included inflation rates within a certain range of the best performing members, fiscal deficit below 3% of the GDP, total government debt below 60% of the GDP, stable interest rates, stable exchange rates. This was crucial. You can't have countries with widely different inflation rates or out of control fiscal deficits joining a currency union. The discipline of meeting these criteria actually helped some countries reform their economies. Countries that were chronically inflationary, like Italy and Spain, had to finally get serious about fiscal responsibility. And then finally on January 1, 1999, it happened. The euro was officially introduced. Now I want you to understand something important. When the euro was first introduced in January 1999, there was no physical euro notes or coins in circulation. Surprising, right? All transactions were made electronically or by check. You couldn't go to an ATM and get euro notes. The euro existed, but only in bank accounts and computers. Why this approach? Because the organizers were nervous. If something went wrong, if the system crashed, they didn't want billions of physical notes out there that would be worthless. Electronic transactions could be reversed. Physical currency couldn't. So the member currencies, the Dutch mark, the French franc, the Italian lira and so on coexisted with the euro for about 3 years. Businesses and individuals gradually switched their operation to the euro, but the national currencies remained in circulation. Then on January 1, 2002, physical euro banknotes and coins were finally issued, and a month later, in Feb 2002, the national currencies were completely withdrawn from circulation. In 1 month, billions of people went from using their national currencies, which had been stable points of national identity, to use a new supranational currency. It was a remarkable feat of coordination and confidence building. Now, why did European countries make this extraordinary sacrifice? Let me walk you through the key benefits that were promised and to a large extent have been realized. When you had 12 different currencies in the Eurozone, every cross-border transaction required currency conversion. A German importer buying from an Italian exporter would have to convert euro to lire. Banks would charge fees. Bid-ask spreads meant you lost money on both sides of the transaction. Economist estimates that these transactions cost about 0.4% of the region's GDP, billions of euros annually. With a single currency, that cost disappears. A transaction from Germany to Italy is now as simple as a transaction from German state to another German state. The money flows instantaneously with no conversion cost. Before the euro, if a German company signed a contract with an Italian firm for delivery and payment in 12 months, there was exchange rate risk. What if the Italian lira weakened by 20%? The German company would receive fewer Dutch marks than expected. To protect against the risk, companies used financial hedging, buying currency futures, options and other derivatives. These hedging instruments cost money. With the euro, that entire cost disappears. A company in Germany delivering to Italy no longer needs to hedge. The exchange risk is gone. Before the euro, if you wanted to compare prices across Europe, you had to convert currencies. Is a German car cheaper than the French car? You had to look up to the exchange rates, do calculations. With the euro, a price in Germany is directly comparable to a price in France. The same currency means instant price transparency. This sounds simple, but it's profoundly important for consumer welfare and market efficiency. When you remove barriers like currency conversions, the volume of trade typically increases. And indeed, intra-Eurozone trade has grown substantially since the euro introduction. Why? Because businesses are more willing to invest in foreign markets when there is no currency risk and no conversion cost. A French manufacturer setting up a plant in Spain doesn't have to worry about exchange rate fluctuations wiping out returns. Cross border merger and acquisition became much simpler with the euro. Combining two companies in different countries was complex before. They had to manage different currencies, different capital gains, different regulatory frameworks. The single currency simplified the capital structure side of things, removing one layer of complexity. So, we have seen an explosion in the European merger and acquisition activities since the euro. Beyond the economics, there was political dimension. Sharing a currency means sharing central bank governance. It means countries have to sit down together and make unified decisions. This required cooperation. Many Europeans felt this was beneficial. It created more reasons for countries to cooperate and fewer reasons for conflict. Finally, on a deeper level, the euro symbolized something profound: economic independence and shared identity. The idea was that if European countries were economically together, sharing the same currencies, requiring each other's markets, dependent on each other's prosperity, then nationalistic rivalries would diminish, peace and cooperation would be reinforced. The euro was in many ways seen as a tool for ensuring peace in Europe. Of course, there are always drawbacks to every policy choice, and the euro is no exception. In fact, the drawbacks have become more apparent in recent years. Let me walk you through the main criticism. Here is a fundamental constraint. A monetary union requires member countries to give up independent control over monetary and exchange rate policies. Once you are in Eurozone, you can't lower your interest rate unilaterally if your economy slows down. You can't print money to finance government spendings. You can't devalue your currency to make your exports cheaper. All of these tools are taken away. The European Central Banks sets a single interest rate for the entire Eurozone. What's appropriate for Germany might not be appropriate for Ireland. This is massive sacrifice of policy autonomy, and it only makes sense if member countries are economically very similar and experience similar economic cycles. Sometimes an economic problem affects one country but not others. When that happens, a single monetary system is deeply problematic. But when shocks are asymmetric, when they hit different countries differently, the constraints of monetary union become painful. I would like to explain this through an example of Finland. Finland is known for its paper and pulp industry. Now, let us suppose that the global prices of paper and pulp industry reduces. Then Finland economy will be affected, while other Eurozone countries will remain unaffected. Now, let us see what Finland would have done if it would have been outside the Eurozone or was having its own currency. Finland could respond by reducing interest rate and allowing currency's depreciation to boost its exports. But since Finland is within the Eurozone, Finland cannot independently adjust interest rates or devalue the euro. Fewer tools are available to Finland to address its unique economic challenges. Now, let us zoom out from the specific case of the euro and talk about the broader landscape of exchange rate regimes available to countries worldwide. Every country in the world has to make a choice about its exchange rate arrangement. That choice falls somewhere on a spectrum. On one end of the spectrum, you have arrangements where the exchange rate is absolutely fixed. A country's literally cannot change its exchange rate unless there is a major political or institutional change. On the other hand, you have freely floating regimes where the exchange rate moves minute by minute based on market supply and demand with no government intervention whatsoever. In the middle, you have various hybrid arrangements, fixed but adjustable, crawling pegs, managed floats, and so on. Now, this is a continuum of the various exchange rate regimes. We have on one hand the monetary union having a single currency, and on the other hand of the continuum we have other side of the continuum we have the clean float. So, if we talk about the exchange rate flexibility, it is minimum or we can say 0 when it comes to monetary union, while it is maximum when it comes to clean float. If we talk about the monetary policy independence, it is 0 when it comes to monetary policy independent, and it is maximum when we have clean float, right. So, we can see this, the choice of where to be on this spectrum is one of the most important decisions a country makes. It determines how much inflation the country can have, how much monetary policy independence the country has, how much exchange rate volatility the countries experience, how much cushion the country has during economic shocks. Today we are going to go through the 5 major regimes ordered from the most fixed to most flexible. For each one I will explain how it works, give you example and discuss the trade-off involved. Let us start at the most extreme end of the spectrum. First one is exchange arrangement with no separate legal tender. This is sometimes called dollarization, though the principle applies to any currency. What does it mean? A country literally uses the currency of another nation as its sole legal tender. It does not issue its own currency at all. The only currency circulating is the foreign, usually the US dollar, but could be any major currency. Panama is a classic example. Panama's legal tender is the US dollar. There is no Panama currency in the wide circulation. If you go to a shop in Panama City, you pay in dollars. If you need cash, you get dollars from the ATM. Panama's central bank does not issue its own bank notes. Now, technically, Panama has an official currency called the Balboa, and the Balboa is pegged to the dollar at 1:1 rate. But in practice, the Balboa is rarely used. The US dollar is the de facto currency. Why does Panama do this? Partly for historical reason. Panama Canal was built and controlled by the United States for much of the 20th century. The most important implication in this, Panama surrenders all monetary policy autonomy. Panama cannot issue its own currency. Panama cannot set its own interest rates independently. Panama cannot devalue to boost exports. Panama cannot conduct an independent monetary policy. If the US Federal Reserve raises interest rates, Panama's interest rates rise too, whether Panama likes it or not. If the US goes into recession, Panama tends to go into recession with it. Why would a country do this? Typically, small open economies do this. Countries with very high inflation problems in their past or countries with close economic ties to the US usually do it. Once you are dollarized, it is politically and economically very difficult to go back to your own currency. You get certainty and low inflation, but you lose flexibility. Moving along the spectrum, we come to type 2, which is a currency board arrangement. A currency board is similar to dollarization but slightly less rigid. Let me explain the difference. In a currency board system, a country has its own currency, but there is a clear legal commitment to exchange it for a specified foreign currency, usually the US dollar, at a fixed exchange rate. Moreover, the domestic money supply is fully backed by foreign currency reserves. Every unit of the local money is backed. It has to be backed by 100% by foreign reserves. There is no fractional backing, no discretion, it is mechanical. There is a clear legal commitment to exchange domestic currency for a specified foreign currency at a fixed rate. Let us say country X operates a currency board with the USD. The exchange rate is fixed at 1 unit of local currency equal to 0.05 USD. If the central banks wants to increase the money supply, it must have foreign currency reserves to back the increase. If it does not have those reserves, it simply cannot increase the money supply. The central bank becomes almost like a currency exchange booth. It exchanges foreign currency for local currency and vice versa, always at a fixed rate. The central bank cannot conduct other monetary policy objectives. It cannot lower interest rates to boost the economy. It cannot increase the money supply to finance government spending. Hong Kong is a famous example. The Hong Kong dollar is pegged to US dollar through a currency board system. The exchange rate is fixed at 7.75 to 7.85 Hong Kong dollar per 1 USD. Hong Kong has maintained this peg since 1983. It has weathered many storms: the 1997 Asian financial crisis, the 2008 global financial crisis, with the peg intact. How? Because the currency board arrangement is so rigid that it forces discipline. When there is financial stress, investors know that the Hong Kong dollar cannot be devalued. They know it is backed by US reserves. This maintains their confidence. Now we move to type 3, which is target zone arrangement and pegged exchange rate systems. This is where things start to become a little bit more flexible. In a target zone arrangement, two or more countries make a mutual agreement to maintain their exchange rates within a specified range, a narrow band around a fixed central rate. The countries coordinate their monetary policies to keep the rate within the band. Let me explain you with the help of an example. Let us say country A and country B enter into a target zone agreement. This means that country A will maintain a fixed exchange rate with country B. Let us say that they have decided that the exchange rate is going to be, this is the currency of country A and currency of country B is 1.20 plus minus 25%. Fine. That means currency A is equal to 1.20 plus minus 2.5% of currency B, which means 1.20 minus 2.5 percent of 1.20 and the other is going to be 1.20 plus 2.5% of 1.20. Now, this gives us 1.17 CB and this gives us 1.23 CB. So, that means that is currency of B. So, the currencies are going to fluctuate within this band. So, here if we see that the currency A has depreciated and here currency A has appreciated. If the currency A starts falling below 1.17, then the central bank of currency A would start buying currency A and selling currency B to push the rate back. If the currency A starts rising above 1.23, then the central bank of currency A would do the reverse. Within this category of pegged system, there are two important variants. First one is the adjustable peg system. An adjustable peg is a fixed exchange rate that can be changed, but only infrequently and with deliberation. Countries maintain a fixed rate against a reference currency or a basket, but periodically, maybe every few years, if the circumstances warrant, the rate can be officially adjusted upward or downward. This was the system that operated under Bretton Woods. For example, exchange rates were fixed, but if a country had persistent trade problems, it would petition the IMF for a rate adjustment. Second one is the crawling peg. A crawling peg is quite different. Instead of keeping the rate fixed for long period and then making occasional large adjustments, the rate is adjusted continuously but in a very small steps. For instance, Peru might operate a crawling peg, tiny incremental adjustments that reflect inflation differentials. Over a year, that is about 1.2% cumulative depreciation, but it happens smoothly rather than one big shock. The advantage of a crawling peg is that it avoids the speculative attacks problem. Speculators know the path of the exchange rate in advance. There is no secret devaluation coming. So, there is less incentive to rapidly exit the currency. Crawling pegs are more appropriate for countries with persistent inflation differential. If your inflation is consistently 3 to 4% higher than the rest of the world, a crawling peg lets you gradually adjust without a big shock. What do countries peg to? When I say countries maintain a peg, I should clarify. They can peg to a single currency, usually a US dollar, a basket of currency based on their major trading partners, the SDR, the special drawing rights we discussed in the previous lecture. A small economy vulnerable to currency fluctuations often pegs to the currency of its largest trading partner. A Southeast Asian country might peg to the dollar. A country in Central Africa might peg to the euro. Some countries have gotten more sophisticated and created their own basket. Mexico might weight the US dollar heavily since the US is its largest trade partner, but also include the euro and the yen. Next we have type 4, which is managed float, sometimes called a dirty float. This is a halfway point. The exchange rate is primarily determined by market forces, but the government intervenes periodically to manage volatility. Here is the philosophy. We want the exchange rate to reflect market fundamentals most of the time. That's good for efficiency. But sometimes markets can be irrational or volatile. When exchange rate swings become excessive, we want to smooth those out. How does intervention work? Central banks can intervene in two main ways. First one is direct intervention. The central bank enters the foreign exchange market, buys or sells its own currency. This increases the demand for rupee and supports the exchange rate. Conversely, if the rupee is appreciating too rapidly and hurting export competitiveness, the RBI can sell rupees and buy dollars, increasing supply of rupees and pushing it down. These are actual transactions in the forex market. They are not hypothetical. Second one is the indirect intervention. The central bank can also influence the exchange rate by altering interest rates. If you want to depreciate your currency, you lower interest rates. Lower interest rates make your currency less attractive to hold. Investors want higher return. So capital flows out and your currency weakens. Conversely, raising interest rate attracts foreign capital, strengthens the currency. This is less direct than actual forex transactions, but it is also less visible and sometimes politically easier to implement. India operates something close to the managed float. The Reserve Bank of India allows the rupees to trade, but it monitors the rate carefully. When the rupee weakens too fast, say during a capital outflow crisis, the RBI intervenes to support the rupee. When the rupee strengthens too rapidly and threatens export competitiveness, the RBI can smooth that out too. India has significant forex reserves over $600 billion, which gives its capacity to intervene. The RBI's intervention isn't constant or heavy handed, it is tactical. It occurs when volatility becomes excessive or when market moves seem to deviate significantly from the fundamentals. Finally, at the most flexible end of this spectrum, we have type 5, which is independent float, also called a clean float. In an independent float, the value of the country's currency is determined entirely by market forces of supply and demand relative to other currencies. There is no peg, there is no managed intervention by the central bank. The float floats freely. The currency is not pegged to another currency or to a basket. It floats against other currencies based on market rates. The market rate is not managed or controlled by the government or central bank through intervention in the forex market. The central bank achieves maximum monetary policy autonomy. It does not have to worry about defending an exchange rate target. It is free to set interest rates based on domestic inflation and growth objectives. Most major currencies operate on a clean float. For example, the US dollar, the euro, the British pound, the Swiss franc, the Japanese yen. These are the currencies of large developed economies with deep financial markets and strong institutions. They can afford to let their currencies float. Let me synthesize the key trade-offs we have discussed throughout this lecture. This is the conceptual heart of why different countries make different choices. When a country adopts a fixed exchange rate system, whether it is dollarization, a currency board or a strict peg, it results in reduced autonomy in monetary policy decisions. You can't set your own interest rates independently. You can't print money. You can't devalue. these tools are off the table. However, a fixed rate strategy often leads to decreased inflationary pressure. When your money supply is strictly constrained by reserves or by the requirement to match a peg, you can't inflate. Government can't print money to finance deficits. This forces fiscal discipline. Next is strengthened reliability of international trade. Importers and exporters know the exchange rate won't change. They can make contracts with certainty. This encourages trade. Finally, we can say the fixed rate approach is good if your main concern is inflation and you want to build credibility. When a country adopts a floating rate, whether it is a clean float or a managed float, it provides greater monetary flexibility. You can pursue your own monetary policy. You can lower interest rates when economy slows. You can raise them when inflation rises. But floating introduces challenges. Exchange rate volatility and uncertainty. Business face currency risk. Investment becomes more complicated. When your currency depreciates, imports become expensive. This can drive up inflation. That's all for now. Thank you.